we look? Because, the first thing that I look for is economic drivers, right? So what's your employment look like, right? So are you having companies move in, employment growth? Because with employment growth, you're going to have population growth, right?
Mm.
And with population growth, then you're going to have people that need to stay somewhere, right? You have the jobs, you have the people. That's exactly what you need, and a landlord-friendly environment, is a lot like Texas. Texas is a business-friendly environment, and it's also landlord-friendly. So, it gives it that, the specific recipe that you want to see for investing or finding, good opportunities to invest in.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Juan Vargas of Gen Wealth Capital Group out in Houston, Texas. How you doing, sir?
I'm doing fantastic, and I hope you are as well. And, I really do appreciate the opportunity to be on your show. And, I'm excited for it and excited for your listeners as well.
Absolutely. So just a little bit about Juan. He is the president of Gen Wealth Capital Group in Houston. He's also the host of Commit to Wealth podcast, which is a very popular podcast. I listen to it. A lot of great content and a lot of great guests, and we'll be kind of digging into a little bit about your show. But for those who are not familiar with you out in Texas, could you just kind of give a little bit about your background and kind of how you got started in real estate?
Yeah, for sure. So going back, I guess in my early years, my dad and my mom, they always had that entrepreneurial drive, right? So they're immigrants that came to the States. I was born here, and so they always had that entrepreneurial drive. Like mom had a restaurant, and she always did that. And then my dad, he was a welder by trade, but he also owned real estate. So he bought houses, right? So he bought houses as rental properties, and I saw that growing up, right? So, and so my dad, I remember my dad always telling me, "Hey, man, you have to get into real estate. You have to buy some houses." And at that point, I was like, "No way, I'm not doing this." Like I can't do this because my dad was the one. He was pretty much the one that acquired the houses. He was the general contractor, the maintenance guy, pretty much everything. He did everything, right? And so I would see him, go to the houses and fix up, the toilets or the sinks or whatever was leaking, and do those kind of repairs. And I'm like, I don't see the benefit to doing this. Why would I want to do this? And this is you thinking as a child or as a younger kid. But it wasn't until I got older that I started realizing, hey, real estate really is a good way to create some passive income. It's just that my dad wasn't doing it the proper way. He was kind of doing it all by himself, and he wasn't leveraging people, and so so I guess my professional background was with BMW. So I was with BMW for a good while. I have 3 boys. And so with my boys, really for me, it was about spending time with them, right? And I wanted to be with them. And, having a W-2 job is great. But, the downside is that it takes away from you, right? And so for me, I wanted to find a way to get into passive income. And I kept thinking, what is that way? And then I looked back and, I was like, what is right in front of me? My dad told me about this. Let me look back into this because I didn't get into it, until I got older. And sure enough, I got into a first house. I got into the first house. That was a rental property, and then it went pretty much from there. I got a few houses, and then that was pretty much my start into real estate. It was through single family rentals. Because it was the most natural, the easiest way for me to kind of picture it, and it was just easier for me to get into single family houses.
Yeah, we had talked about I think we talked around 2 months ago on the phone, and you had mentioned that, and that's something that really resonated with me. Like my father is the same, where they're like very hands-on, they like doing everything themselves, and it's just like that's something that just really detracted me from getting into it. But when you get older, a little more wiser, you mentioned you have kids now. You're now thinking about family and long term and how to make life easier, especially for the kids moving forward. You kind of go back and say, you know what, he was actually right. But
Yeah.
maybe there's a little easier way because they're old school and we're new school. Maybe we know better. We're trying to figure out
Yeah.
how to do it better.
Mhm.
So that go from single family to now transitioning over to the multifamily. You had the mindset. I don't know, is there a period, an aha moment to say, let me go bigger, let me find out how a way to create it passively instead of the direct manual labor of you kind of fixing the toilets and you being there and dealing with tenants one-on-one. So what was that kind of aha moment for you for that transition?
Yeah, yeah, there definitely was an aha moment, and that aha moment for me was when I was vacant on one of my houses. So it was doing great for a good while, right? And the cash flow that I was making on the house after all the expenses were paid, the cash flow I was making set into the side every single month. So it was building up, right? And I was like, man, this business actually works pretty good.
Mhm.
But it wasn't until I was vacant on that house. The tenant moved out, and part of that was on me for maybe not marketing right. I don't know what the reason was, but I was vacant for over a month. It was like a month and a half to 2 months, something around there, and the expenses don't stop coming in, right? So you still have the mortgage, you still got taxes, you still got insurance, I mean all those things, right? Utilities. So a lot of I thought I had made was going back in there, and so I'm like, you know what? Then what's the point if you're quote unquote cash flowing, but then you have, like, let's say you're a vacancy, or you have a major repair, then whatever you made is gone. You have a roof repair, or you have some AC, so you're 100% vacant. And all your cash flow is gone. So that was really my aha moment. I'm like, you know what? If this happens with one house, you're 100% vacant with one tenant moving out, then what if you bought an apartment and, let's say it's a 100-unit apartment community, you're one unit down, well, you're still 99% occupied. So that was my thinking. And so that was definitely my aha moment from there. And so from there, I started to educate myself a little bit more and go to networking events and, just, read a lot of books and listen to podcasts like this one right here. And so that's what I try to do. And I was like, you know what? It all makes sense. This is what I'm going to do. And shortly after that, I acquired my first multifamily property. It was just a few months later that I
Mhm.
acquired my first multifamily property. And just, from there, they look back.
That's
So
good. So I know you said you went through like the little educational period. Was there any kind of courses or coaches or anything that you took on that helped you propel, or is more just kind of like reading about it and then you was able to kind of jump in and you kind of learn while you was on the job?
yeah, yeah. So I definitely could have joined, some type of educational platform out there. I think it definitely would have benefited me. But I didn't go that route. So what I did instead was I read a bunch of books, and then I listened to a bunch of podcasts. I attended a bunch of networking events, and I was at events where it was nothing but multifamily. So if that's what I want to do, then I just forget the single family stuff. I'm gonna just network with the guys that are doing multifamily and just learn from those guys. And so that's exactly what I did.
Mm.
And then once I learned, really the business is not that hard, right? Anybody can do it. It's just making sure the numbers work out, being confident in the asset, the location that you're buying in, and then just pulling the trigger. So you can't overanalyze. And for me, the numbers worked out on this particular deal, and then I'm like, okay, why am I holding back? Let's do this. So it was that kind of thought process that I went through. And I was like, okay, and made it happen.
Yeah, that's the biggest key thing that you said was the kind of like that mindset. A lot of people, it seems very intimidating, 30 unit, 100 unit. I mean, it's just really the numbers and a little bit, a little bit of strategy change, but for the most part is the mindset. And then for you to kind of be around those other multifamily investors that are doing it, you say, these guys can do it. I can do it. And that energy is probably in the room. And then of course the supplement of your educating, reading through books. And it's like, this is actually not that hard. And once you kind of get a grasp on the numbers and kind of like the process, it gets a lot easier. But as far as going from like, say, a 30 unit to like a 300 unit, Rich, maybe if it need like some financing or some other type of different structure, did you go out and acquire them yourself, or did you JV with other other sponsors to kind of make that leap?
Yeah, for my larger deals, yeah, definitely it was a team effort, and really, I mean, there's a couple of different strategies, that I always like to tell people. One strategy is taking on a smaller deal, right? So you have to ask yourself what are your goals, right? So are you trying to buy a property that you're going to hold on to for 20 years, 30 years? Is that your strategy? And so if that's your strategy, then maybe you can go smaller, get a 10, 15, 20, 30, 40 unit for yourself, or partner up with somebody else and just hold on to it for long term, right? The other strategy could be to where you want to go bigger, but really to go bigger, unless you're really, really deep, then your pockets are really, really deep, then then you have to partner up with others who have also a track record, and it's a collective effort, And so for me on the larger deals, it was definitely a collective effort, get into those, where we all provided some sort of value to the deal, and just took them down. So those are really the two different options that people should be aware about. Is what are your goals? What are your goals ultimately? Because they're not the same. For one, a smaller deal, if you're going to hold on to it for 20, 30 years, you're going to put capital into it at the very beginning. You're going to put capital into it after 5 to 6, 7 years, and then another 5, 6, 7 years after that. And you're going to keep doing that because that's just the nature of it. Things are going to they're going to fade away, and things are going to be needed for repairs, and you have to keep adding capital into it. On the larger deals, we usually run them on a 5-year hold, and that's for several different reasons, because of lending, because of same reasons for capex, and increases the investor's IRR, as well. So, but that's ultimately that is a collective effort. Yeah.
Yeah, it definitely makes sense there. And that's a good tip, is actually looking at what your goal is. If you're going to be kind of, a long-term hold, you do it by yourself, or just maybe like 1 or 2 partners, but, going big, there's other kind of objectives moving forward. And especially that's important too, because we're here in Connecticut and we're looking at opportunities in other states to take advantage of, the better economies. Here in Connecticut, it just doesn't make sense. There's a lot of, it's not a really good investable market. So places like Texas or Jacksonville, Florida, or South Carolinas and stuff like that. So it'll be smart to connect with someone that's on the ground or has really good knowledge of that marketplace that you can work with, to take advantage of those deals instead of just kind of doing these little smaller deals locally, which can work. But, if you want to kind of, do something bigger, that's something that you have to consider.
Yeah. And on the smaller deals, I mean, there's nothing wrong with them. And like I said, my first deal was a 32 unit. I actually, even though I made, some decent returns on it, I sold that property, and now looking back, I actually regret selling the property. It was just a small, good, cash flowing property, and so, like I said, you have to really ask yourself, what are your goals? But the other thing about that is that the smaller deals, they're going to take more of your time. That's just, there's no way around that. It's just going to take more of your time. You can have a third-party property management company oversee your asset. It's just going to cost you more. You don't get the economies of scale like you do on the larger deals. So on a smaller deal, let's say a 30 unit, I mean, they may charge you, 5, 6, 7% for property management. And on a larger deal, you'll get 3% or so, And so that's the economies of scale that I'm referring to. So the smaller deals, yeah, they're good, but then you got to know that it's going to take more of your time. It's going to be more of a mom and pop type of thing. You're going to have to be way more involved, and so on the larger deals, you can hire a full staff to be on site, and and you can just oversee them, make sure that they're doing their good job,
Yeah, that's a really good point. And like I said, it really depends on your goal ultimately. But yeah, the smaller deals would have some type of oversight. However you do it, there's always going to be that. So for like the larger deals, you're heavily invested in Texas, and I understand more of the Houston market area. Is there any other markets that you guys are buying in?
Yeah. So we're actually closing on one this week in Dallas.
Nice.
It's a 184 unit, $15 million deal. And so yeah, Dallas is definitely a market that we like, because, first of all, Texas is where we look, I'm based in Houston, but Texas is where we look because, the first thing that I look for is economic drivers, right? So what's your employment look like, right? So are you having companies move in, employment growth? Because with employment growth, you're going to have population growth, right?
Mm.
And with population growth, then you're going to have people that need to stay somewhere, right? You have the jobs, you have the people. That's exactly what you need, and a landlord-friendly environment, is a lot like Texas. Texas is a business-friendly environment, and it's also landlord-friendly. So, it gives it that, the specific recipe that you want to see for investing or finding, good opportunities to invest in. But Dallas has one of the most diverse economies out there in the nation. It's continuing to grow. There's a bunch of Fortune 500 companies that are moving in, and the population growth is just booming. And as is Houston, but we just found a good opportunity in Dallas, for this particular deal, this last one. But yeah, we're definitely looking to expand, even more in the Houston area and even San Antonio. We don't have anything in San Antonio, but we're looking to expand into San Antonio. But we are also looking in Florida. Florida is a good market as well. So a couple other markets that we're looking in that we are very close to getting under contract are Arizona. So that's another market that we're also feel very good about, and so we're confident in those markets. And they all have the similar key drivers that we look for.
Mm. Yeah, I like talking to investors in different marketplaces and kind of learning more about the market. Your boots on the ground, so it's like I'll definitely be connecting with you to kind of learn more about that area as we kind of look to kind of expand our investments, especially like in Florida. Just so much stuff here in Connecticut. It's like you kind of read about it, but you really have to talk to the investors that own stuff and are doing the research and talking to brokers and property managers and know the values of the property to really kind of get a grasp on that. So that's a really big tip for any the listeners out there to really kind of connect with people locally so you can really understand the landscape. As far as the types of neighborhoods, is it more B, C class that you guys are targeting? What type of stuff are you guys looking at?
Yeah, that's a good question. So yeah, we are looking for the B and C. You're exactly right. I mean, B and C class. The reason for that, so we don't look at A at all, right? A is the newer stuff. I mean, we don't look at that because the returns are just not there, right? Those are more for the institutional guys, and for them, they're okay with a 4 or 5% return, and so our investors are not. Our investors are looking for somewhere in the 7, 8, 9, 10% return, and so to be able to achieve those returns, we are therefore looking in the B and C type of neighborhoods, B and C type of properties, B and C class properties. Another reason why we like the B and C, or the B especially, is because the majority of our tenant base in America is workforce housing. They're B class tenants, and so you have a big demographic there that is not going to go away, and it's gonna be there for a long time, and they have a strong need. And so in Texas, for example, we had an economist come out a couple of months back here in Houston, and so he was saying that in Texas, in the B and C markets, we have an undersupply. We're undersupplied, So that means that, whatever it is that we have, is going to be in demand, so there's just a big population that is looking for that affordable, I wouldn't say affordable, but that workforce housing that is still affordable. Now, there's not affordable housing by any means. It's workforce housing, but affordable workforce housing. That makes sense, So yeah, definitely we're looking in the B and C type of assets.
That's really interesting. How is the Houston marketplace kind of recovering? I know with the big storm, has that market kind of picked up, and like how's the investment kind of working out in that area?
Yeah. So there was a dip in occupancy, obviously, because there were some. I mean, there was some dip in occupancy here recently, but as soon as the hurricane happened, there was a big increase in occupancy, right? So a lot of people lost their homes. So a lot of the homeowners, they moved into apartments, right? So you saw a big rise in occupancy and also rental rates, as soon as the hurricane, after the hurricane happened. Now recently the occupancy went down, and so but it's picking back up again. So it was like a cycle in itself. So it went up because as soon as the Hurricane Harvey happened, then it went down as those homes started to get rehabbed, and people were moving back in, and then now it's picking back up again. So in Houston, while the rest of the nation, we're still in the ninth inning. We really don't know what inning we're in. We're somewhere up there. And so we're expecting some kind of downfall, right? We're expecting some kind of market correction or softening, right? When Houston, it's already had that sort of effect. We went up, and then we went down, and we're going back up again. So a lot of guys are looking at Houston because we've, a lot of economists, a lot of the brokers, the way the market is right now, it's kind of sort of already had that recession, so it's kind of had like a little mini recession, so to speak. So Houston is a strong market. It's the fourth largest city in the nation. It's not going anywhere. It's the most diverse city in the nation. A lot of people don't know about that. They think, maybe LA or New York, but it's Houston is actually one of the most diverse cities in the world. And so it's definitely a melting pot. It's not going anywhere, and it's strong economic drivers. Not like it used to be, just where it relied on oil and gas primarily. It's much more diverse than it was back in the 80s. And so definitely a strong market for sure.
Yeah, that's the big thing. Like I said, it's not going anywhere. It's always been kind of very diverse, but now, like with the economy picking up, a lot more oil and gas drilling, more companies moving down there. So it's a very hot area. I mean, all of Texas, but especially with the Houston and Dallas Fort Worth and all those stuff. So that's really good to hear. As far as on the property level, what type of deals you guys are attracted to as far as for repositioning? Is more managerial? Is it like really large renovation turnarounds, or more cosmetical stuff? And what are the type of deals that you picked up, and if you can give us some examples?
Yeah. So going back, there's a Class A stuff that doesn't really need much. We don't look at that. There is some stuff that's value add. You call value add, right? Where on those value add, it could be operational. So it's a management play. They have higher than normal expenses for the marketplace, or they the rents are below market, whatever, something like that, right? It's operational. There's also the where you can force the appreciation because for one reason or another, there's CapEx that needs to be involved or that needs to be added. There's deferred maintenance. So there's that light value add. There's also the deep value add where the property could be not stabilized. It could be 50-60% occupied. It needs 10 grand a door to get it turned back around. It's in a rougher area. We stay away from those. We stay away from the deep value add. We prefer properties that are stabilized. Stabilized meaning they're 90% or higher in occupancy. We are open to properties that are high 80s. Maybe low 80s, where it's not stabilized, but there's opportunity to in operations to get it to that 90s, and then get to that point. But we stay away from the deep value add, and we stay away from the Class A stuff, as I mentioned. So the type of stuff that we're looking at for is like light value add. that's like I said, improving the unit interiors, improving the exterior, and pushing the rents a little bit, improving the efficiencies of the expenses as well.
Yeah, so that's good. So like you're probably looking for something, you said stabilized, but maybe something if you had to do a turnover on a couple units. So you guys probably targeting to get get everything moving along in a month or two, so you can start seeing some returns on your cash. As far as like target hold period times, are you guys buying and maybe trying to resell after it's 90+% occupied, or are you just kind of holding it for 5-7 years? What are you guys trying to do?
Yeah, that's a good question. So, it really depends on the strategy. It depends on how the investment opportunity was at the very beginning. So if it was a deal that maybe was 80% occupied, as I mentioned, and there's a good opportunity to go in there and turn the property around, then we would go in there and hold on to it for a year or two, and refi, not sell, but refi, because now it's stabilized, and then we can return a big portion of our investors' capital. Everybody still retains the same equity position, and then they cash flow, so they got the majority of their capital back. They have very little money in capital invested into the deal now, and so the risk is way lower now, right? But they still get the benefits of the cash flow moving forward, and the equity position. So on other type of deals that are already stabilized, that can be pushed a little bit and improved, as far as the NOI is concerned, those we try to hold like somewhere in the 3 to 5%, 3 to 5 year hold. Could be a little bit longer, depending on what the market is dictating at that point, really. So we can't say that we're going to hold a property for 3 years, because we don't know what's going to happen in 3 years. We don't say that we're going to hold a property for 5 years, because again, we don't know what's going to happen in 5 years. The market is pretty much going to dictate what we will do. If the market is very favorable in 3 years, then we will definitely sell. As long as we reach our the projected returns for our investors, the projected IRRs, then we will then sell. If it's not, then we'll hold longer, until it's the right opportunity to be able to sell.
Yeah, that's definitely smart. You guys are looking at it on a deal by deal basis, and then kind of really being smart at looking at where's the best opportunity if it's need to sell or hold it longer. And that it gives you more confidence with your investors. They'll be more happy, and then willing to commit longer with you guys, or just stay long term, or even get more referrals. That's very smart to do. Speaking of investors, what's kind of like the makeup of your investors? Is it more kind of real estate investors? Is it more like entrepreneurs, like doctors, lawyers that just want kind of passive cash flow? What type of makeup is your types of investors?
Yeah, that's a very good question. I mean, we have a mixture for sure. We do have some medical professionals. We have some other professionals that are in the IT space. Engineers. The majority. We're all real estate investors. If you invest in our deals, we're all real estate investors. But the majority have their W-2 careers. They're well paid professionals that want another form of passive income. And that's what they're looking for. And they're doing good in their careers. They're not going to leave their job tomorrow. So they want something more to supplement their income, to be able to live a more comfortable lifestyle. And so in addition to that, you get the tax benefits. They love it because of the tax benefits that real estate provides. And the cash flow it provides. So yeah, we definitely have a mixture of different investors with different backgrounds for sure.
Yeah, that's definitely key there, because I did a previous interview with a lady that really talked about high net worth entrepreneurs, or W-2 workers, that they're trying to get that high tax income over to passive income. It's just a smart tax strategy. And then moving forward, the name of your company is Generational Wealth. They're trying to build wealth for the future, is that they have to think of smart ways of deploying their their income. So that's very smart, and you give them that platform to do that.
Yeah. I mean, those tax benefits, and I'm not a CPA by no means. So just but yeah, I gotta make sure I say that. But the tax benefits are definitely strong. They definitely do help. Just, right now that how with the new tax laws that got implemented in just a couple of years ago when Trump got elected, those tax, benefits are really strong. And so, we have bonus depreciation now. And it really does help to accelerate that depreciation. And so you have like that phantom loss, even though you had a gain, you had a loss on paper. And so it just really helps, so, but that being said, you do have to check with your CPA, because you take advantage of those if you are a real estate professional. So you got to make sure you're a real estate professional to be able to take advantage of those, fully take advantage of those tax benefits, so.
Yeah, definitely.
Yeah.
You had mentioned it just briefly, and I'll just kind of see if you had any other thoughts on any other markets that you guys are looking into. I know you had mentioned, the deal in Florida. I know we had talked on the phone. You was also, looking around at some other markets. Is there any other markets you guys have some eyes on?
Yeah, definitely. You mentioned Jacksonville, Florida. That's definitely a market that I'm actually deeper into one deal right now. That we're looking into, and it definitely makes sense. We like Jacksonville. We like the triangle in Florida, the northern triangle. So the Orlando, Tampa, and Jacksonville markets, that triangle. So that we feel that's it's a growing area. The jobs are growing. People are moving in, and so we definitely like that market in Florida. And so, as I mentioned, Phoenix is another strong market. Phoenix and Tucson are a couple of different markets that we like in Arizona. Another one is Albuquerque, New Mexico. That's another strong market. And like I said, the Texas markets in general, even the secondary markets in Texas, such as Abilene, Paso, Waco. I mean, there's a lot of stronger secondary markets here within Texas that are out there, not the primary markets. So everybody knows about the primary markets, the Houstons, the Dallases, and Austins, San Antonios. So Atlanta, Georgia is another market that we definitely are looking in, have analyzed some deals in. And so that's another really good market that we like too.
Yeah, very good stuff. Yeah, I'm like, I'm just looking at especially the Carolinas. There's also some good areas there. So I'm just learning more about it. So it's, glad that you're starting your research on there. Go ahead. I'm sorry.
Yeah, no, I was going to say, for anybody out there listening, don't, you hear this a lot that, invest in your backyard, if you want to start out, like look in your backyard first, right? That's what you hear all the time. Well, I think that's a good advice, right? Overall, because, it's in your backyard, you're familiar with it. I think it also kind of hurts you at the same time, because if you're only looking at your backyard, then one of the worst things is, man, this thing is selling for $80 a door. I remember just a few years ago, it was selling for $30 a door or $40 a door. There's no way it's a good deal. I'm not buying that. Well, the guys that are buying in your own backyard are guys that are out of state, so the guys that are in California or the guys that are international or whatever, those guys are like, hey, 80 grand a door, that's a deal, because the numbers make sense. And so they're able to make the numbers make sense. It just makes sense for us that are local. We keep thinking, oh man, it used to be, 30, 40, 50 grand a door. I can't imagine paying, 80 grand a door now. It just doesn't make sense. Why let somebody else overpay for that? And so you may think you're overpaying, but it's still a good deal because rents went up, so that's, 30 grand a door, the rents were here, at 80 grand a door, the rents are up here. It's still, it's worth it, so it's that's one thing that I would say, it's good advice to look in your backyard, but it's also good advice to look elsewhere in different markets. Don't be afraid to go to other markets, just because they're not local to you,
That is such good advice. And I have that same conversation with a lot of local investors here, and they want me to go out and look for deals in our backyard. And I watch everything. And it used to be like you were saying here, it was like, a good deal was like $35,000 a door. Now it's like 60, 65,000. And, the marketplace, everybody's just like a big exodus out in Connecticut. And I'm saying it's not a good deal. And they're saying, well, let's look at it. But the people who are buying it are New York and Boston. So they're bringing in New York money and the Boston money. So of course that would make sense because they're used to, like Queens or Brooklyn, used to paying like $200,000-$300,000 a door. Here is totally different. So they say, oh, that's a great deal, but yeah, so you really got
Yeah.
to be really looking at it. So that's a good point. I'm glad you had brought
Yeah.
that.
So, I mean, I would encourage anybody to don't be afraid to look outside your market. I would say if you're going to go outside the market, then find, bigger deals, because you want to have, full staff on site, right? So look for bigger deals. If you're looking in your backyard, it's okay to look for smaller ones, as long as, it's within 30 minutes to an hour, of a drive. But, don't be afraid. I mean, don't look at the price. The prices where they were back then, like, as I said earlier, because you're never going to buy anything, just remember that, at 30 grand a door, the rents were down here at, 500 bucks a unit, and now at 60 grand a door, they're at 800 or 900 a unit, so it's relative, so, that's your NOI right there, so you got to make sure that, although the prices are higher, the rents went up too.
Absolutely. So for the syndicators that are listening on the show, can you kind of talk about your capital raising process? How are you, attracting investors, or some different tips you can offer us?
Yeah. So, one of the things that I do is, I do have my podcast, right? So my podcast, I think it's good to have some type of, platform, and people can know you, right? People can feel comfortable about you. They hear you every single day, right? So they hear you all the time. And if they don't like you, they don't like you. If they do, then they do. But they'll hear you. There's enough content out there that people will know about you, right? So, be active, online, through social media, Facebook, LinkedIn, whatever. Be active on those. Be known, right? So, add value. Look to add value all the time, and don't look to take. Always look to give. I know it doesn't sound productive, but that's really the key right there. Host meetups if you can. That's one of the things I do is host a meetup. Just go in there, and if you don't have the experience, and I know you mentioned for syndicated, but even for those guys that don't have the experience, if they don't have the experience, it's okay. Bring in somebody that does have experience, and then it will kind of put you on their level. You don't have to have done 10, 15, 20 different deals. It's okay to to have one or two deals, or if you don't have anything, that's okay too. Bring in somebody that has a track record and host a meetup with them or something. And so for those syndicators out there, have some sort of meetups, network a ton. That's one of my favorite things is networking. I get it out there as much as I can and just talk to a bunch of other people, other syndicators, other investors, just learn about what their strategies, what they're doing, their markets. I just try to get out there as much as possible. So the biggest thing is to be yourself. Don't try to be anybody else that you're not. Be yourself, and look to add value, as I said. So
Absolutely.
yeah.
Yeah, it's good points. And just kind of talking a little bit about your meetups. Is that you do that monthly, weekly, or how do you kind of run yours?
Yeah. So I do it monthly. I'll have the next one here in a couple of weeks. But yeah, it's monthly for sure. And every time I get out there, try to have somebody, something different to talk about, right? So the next one is going to be passive investor panel, right? So it's going to be passive investors that have invested in several deals, and talk about what they've done and the good and the bad, of their investments, what they like to see with the operators, the sponsors, how they like their communications, type of deals that they're looking for. So those kind of things. The next time it'll be something, with maybe bringing a lender, maybe bringing a property manager, talk about their expertise, in their specific space. They'll always have something to add value to, and, I do that on a monthly basis.
Yeah, education is key. I go to a lot of meetups, meeting investors, and like I said, stuff like yours. So like, people that are in the Texas area that are listening to this call, make sure to put your information in the show notes so they can come, meet you and, check out some of your guests and other attendees as well. As far as you gave out kind of the blueprint of kind of transitioning from single family over to multifamily. Is there any more tips that you can offer kind of starting out syndicators that maybe that could help bridge the gap for them to kind of, move up to the level that you're at?
Yeah, I would say, get educated. You hear this a lot, and you hear it all the time. It's not going to change. You have to get educated. Because if you want to be a syndicator, I mean, this is not, I mean, this is a real business. I mean, this is a serious business where you have to be aware that it's a big responsibility because you are managing other people's capital. So a lot of the newer syndicators, they want to do it because the potential of the money that you're making. Well, who isn't in the business for money, right? But there's a big responsibility that comes with it as well, right? So it is a fiduciary responsibility that we have to our investors to make sure that we are being responsible, that we are doing the best we can to not only protect our money but to grow it. So that's one of the biggest things I can say. But yeah, that's definitely the thing right there. Yeah.
As far as I know, you've seen a lot from boots on the ground and kind of having your hands in all the different aspects of the whole investment process. Was there kind of any mistakes or stuff that you wish you did differently that you can kind of inform our listeners to kind of avoid, so they can maybe, I know you can't avoid everything and you kind of learn along the way, but if there's any kind of insider tips, that would be very appreciated.
Yeah. So the deal that I did, the 32 unit, I mean, really don't have, thank God I don't have that many mistakes that I've made up until this point. But one of my biggest, I guess, mistakes was with going back to the first property, the 32 unit was, I sold it, right? So it was a good opportunity. It was a good deal, and for me, I ended up selling it. And so, for what I would say for those out there, if you have a good deal, hold on to it. You can refi out of it, or not refi out of it, but you can refi, pull out of the equity out and hold on to the property. Keep the cash flow coming in, keep the tax benefits. There's a lot of good things to it. I do have a bunch of other properties, in addition to that one, but that was a good one. So definitely know when you have a good deal, and going back to looking in your own backyard. I mean, there's a lot of good opportunities in your own backyard that you need to look into, as well. So that's what I would say. There's not a lot of, I guess, mistakes that, like I said, I've done, luckily, to this point.
That's good, because you said the education and kind of aligning yourself with good partners and just constantly just being self-aware. And then of course, Texas is such an abundant marketplace. You not really have to go out much far to kind of navigate the waters. You kind of know everything there, and it's like I said, the lucky that you're living there, so everything is, and it's a great marketplace. Everybody else wants to be there, so that's very cool. So can you let us know about your podcast, Commit to Wealth? I love the name, the messaging behind it, is because it kind of instills kind of a mindset of of long-term wealth. We talked off camera about your family, which is very big for you. So if you kind of tell us a little about what inspired you to start it, and kind of some of the topics that you cover, and just a little bit of insight about that.
Yeah, no, I appreciate that. Yeah. So yeah, I am the host of the Commit to Wealth podcast. It's a podcast that, wealth, the definition of wealth in the podcast is having everything, right? Is not money, is not, or I should say is not only money. It's having health, having family, having your spiritual values, health, having them all combined, that is wealth. Having time, time for your family. That's really big right there. So for you to be able to get to that point, then you have to be able to commit to it. It doesn't come, if you don't want it. It's not going to be there for you if you don't want it bad enough. So you have to be able to commit to it every single day, grind for it, make it happen. And that's what the podcast is about. So we use real estate as a vehicle to help us get to that point, right? So, and so the topics that we cover in the podcast are topics, in real estate in general, from single family to self-storage to mobile home parks. But the biggest bulk of the topics that we cover is multifamily. And that's because I'm a multifamily investor. I'm a multifamily syndicator. And so, that is what I know best, and so that's the biggest bulk of the podcast interviews that I do. So it's a weekly podcast that's out there on all the platforms. And so some of the guests that I've had, I've had Robert Kiyosaki, a lot of big time syndicators, recently had Grant Cardone, if you guys don't know who he is. And so a lot of, high level people, and they've added a lot of content, and so it's just very exciting. I love doing it. So
Yeah, the one that really that I liked a lot was the one you just mentioned, Robert Kiyosaki, and I think he's one of the people that everyone resonates with that say that they either got their start from him,
mhm.
they got their push from him from reading his books or watching his stuff. It's just his story, his knowledge, and then how he just kind of educates you, kind of gets you motivated to kind of like get started. So can you tell us like how was that experience, talking to somebody like that on that level? And and what were some of the key things that kind of resonated with you that you can kind of motivate our listeners?
Yeah. So first of all, if you don't know who Robert Kiyosaki is, then you need to look him up. And so if you are just learning real estate, this is your one of the first times listening to Dwaine's podcast, then definitely check out Robert Kiyosaki. Just look him up. Read his little purple book, Rich Dad Poor Dad. It's one of those, if you still have the old school mindset of going to school, getting good grades, going to college, getting a good job, and investing for the long term in the stock market, like Robert Kiyosaki says, then it's going to be definitely an eye opener. And you're going to be like, man, where the heck have I been this whole time? What am I doing? It's going to be one of those kind of moments. So I would say, read his book, read the Cash Flow Quadrant after that as well. Though they're all really, really solid books. But yeah, just getting the opportunity to talk to him was really a special experience because, for me, I was already in real estate and, I already had, single family houses, but, I kept hearing about this purple book, and so I was like, you know what, let me pick this book up and let me see what all this fuss is about, man. Let me see what all this drama is about with this book, but whenever I read it, I was like, man, I was exactly what I said earlier. I was like, man, what the heck have I been doing, with this whole time? I've been doing it wrong, and it's just because we were never taught any of that. It just our government doesn't push our school systems to teach us about money, and they never have, and they probably never will. And that's because they want us to be employees. Somebody's got to pay the taxes, and somebody's got to get, pay those high taxes, the 30-40% taxes, so you got to have somebody like that, right? And so they don't want everybody to know about that. And it's really up to us to educate ourselves, to know more about that. But Robert, man, he's a special guy. He pretty much what I had read, about him and his books. He's a true believer that you have to go out there and make it happen, yourself. And he doesn't talk about real estate in general. It's not about real estate. It's about creating enough income and using taxes to your advantage. That's really what it's about. Income and taxes. Just think of it that way: income and taxes, but having them in the right quadrants. If you read his book, The Cash Flow Quadrant, you got to be in the B&I quadrant. They'll be in the E and S. The E is for employee. The S is for small business or self-employed. You don't want to be in the E and the S because those are the highest taxed brackets. You want to be in the B and the I, which are the lowest tax brackets, and you can even potentially have zero tax. And that's where you want to be. So you got to move over from the E and S to the B and the I. And that's what it's about. So that's through being a business owner, invest in real estate, just having employees, that's what it's about, being the I. So yeah, it really was a great experience, and I really, really enjoyed talking to him. And he's just another guy like one of us, but just he's been there, done that, so it's pretty cool.
Yeah, I got that like you just said, that kind of that experience. It's like it was the same for me as I was watching the interview. It's just like I just love hearing other investors talk about it and get like excited about it. But for me, he just like you said, challenged the mindset of just the employee mindset over to the investor mindset, and everyone can do it and everyone should be doing it. It's just not enough education out there. And like I said, your podcast, Commit to Wealth, is always kind of talking about that and reinforcing that to get people to really realize it and to take action to do it. And like I said, everyone can do it. It's just just got to take the first step.
Everyone can do it. There's no question. You're exactly right. Anybody and everybody can do this. You just have to have the proper education. Have to have the right mindset. Because you can still have the education and you still don't believe in yourself, then you're not going to get anything done. So you got to make sure you have the right mindset. That's one of the most important things. And then, just push forward, push forward. I'm not trying to turn this into like a motivational type of, podcast or anything, but, I really do believe that anybody can do this, and we limit ourselves to our abilities, 100%. Like most of the time it's on us. Most of the time, the reason why we don't get things done is because we don't have the confidence in ourselves, so, you just got to go out there and do what you can and push forward, and the sky's the limit. It really is.
Yeah, I'm glad you touched on that. Is besides from Rich Dad, Poor Dad, Cash Flow Quadrant, is there any other books that helped you along your way that you can share with us that I can put on our reading list?
Yeah. So as far as real estate is concerned, there's a bunch of books that I can recommend on real estate side. The Millionaire Real Estate Investor is one of them. But the other ones are Emerging Real Estate Markets by Dave Lindahl. There's another one called Multifamily Millions by Dave Lindahl. Those are on the multifamily side. As far as motivational, self-driven type of books, one of my favorite ones by far is Can't Hurt Me by David Goggins. If you haven't read that book, you're missing out. And I would highly recommend that you get the Audible version versus the paper version, the book version. Get the Audible version because they not only is he having somebody read it, but then in between the chapters, David Goggins himself is they're kind of doing like as a podcast / book. So then he'll say, hey, so David, what was going through your mind at this point, whenever this happened? And then so David, comes in and he talks about his moments and why he did whatever he did. And so it's more personal and you get deeper into the book. But man, that's a book that it's, I put it way up there on the list as a he doesn't like motivational. He doesn't like the word motivation, but it's a driven type of book, and it's solid, man. So I would really recommend that one.
Absolutely. So like we talked before, you're very big on family. Is there anything else that you can say that you are grateful for, every day in what you do?
Yeah, that's good. That's good. Family for sure. As you mentioned, family is, sometimes what we take for granted, right? I have 3 beautiful kids. Ultimately you have to, think about, what it is that you're doing. Why is it that you want to get to the point that you want to get to? For me, it's always been my family, right? My 3 boys, my wife, God, so, there's people out there that may not believe, and I respect that, but, I do. So, God is one of the reasons, as well. I like to donate my time at church. I like to go out there and volunteer and do what I can. But also I believe that, as we spoke earlier, that anybody can do this business. And, that's part of the reason why I do the podcast. And that's part of the reason why I spend a lot of time doing it. It costs me money to do it, but I still do it because I think that, a lot of people limit themselves to their abilities and their potential, I'm definitely grateful for the opportunities that we get in this country. I'm grateful for a lot of things, I could go on and on, but those are the top ones, for sure.
Absolutely. Yeah, I respect that a lot. And I respect like your hustle and your grind and like your persistence, like I said, the education and doing all these deals and stuff. Kind of what's your morning routine or like your day-to-day routine that people can kind of, foster or maybe mimic to help, foster their success?
Yeah. So what I do is, I don't do this every day. So, don't think of this as, every single day, but, wake up, say 5:30ish, nothing too early. Wake up at 5:30, excuse me. And then, get up ready to go to the gym, come back, and then, help my boys, get ready for school. After that, then get ready for the grind, shower, get ready for the grind, and that's kind of, doesn't sound, great or sexy or anything like that, but it's something that works for me. That's what I try to do all the time. It's you got to get the exercise in there for sure. For me, that's one of my favorite things. And, it allows us to be full of energy, allows us to keep pushing throughout the day, because your energy runs out,
Mhm.
So I like to have a full high level state of mind.
Absolutely. Yeah, good tips. So just kind of ending, how do we get in touch with you? Either your meetups or your website or, your podcast address and stuff like that. How do we get in touch with you?
Yeah. Thank you. So you can listen to the podcast, committowealth.com, or, find it on all the platforms like iTunes. My company is Gen Wealth Capital Group. You can find that at genwealthcapital.com. And I'm always free to talk. Well, I shouldn't say it like that. I'm not always free to talk, but I'm always willing to talk, So if anybody has any questions or wants to reach out for whatever reason, feel free to shoot me an email. Juan at committowealth.com or Juan at genwealthcapital.com. Those two different ways. And, I'm free to and open and talk shop.
Absolutely. Yeah, I really appreciate it. Again, we got a lot of good nuggets. It's just always good connecting with you. We got a lot of good vibes. I really enjoy our talk and look forward to have another talk in the future and kind of give us updates on how your business is going. And then, like I said, continue to network in and, ultimately meeting you down in Texas one day. So I really appreciate it again, Juan, and, bless you and the family, and we'll be talking to you soon.
Hey, Dwaine, I really do appreciate you. And, thank you for the opportunity to be on your show, and hope that your audience enjoyed it. And, thanks again, and wish you continued success.
Absolutely. You too. All right. Take care and talk to you soon.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.